This commentary is not intended to be investment advice, investment research, or recommendation. Please consult your investment professional for your own circumstances.
Hey everybody, welcome to Between Two Chains. It is Tuesday, March 21st, and I am joined by longtime business partner and frequent guest, Arca CIO Jeff Dorman. Jeff, how are we doing? Busy weekend?
Busy weekend, busy month. Yeah, doing well.
Yeah, busy past week or so. It's funny, every time, and I think it's been like this for the past 3 years, that I go on a vacation of any sort, the market rallies. It's happened consistently. Even last year, the market rallied, and I think the opposite is true of you.
Yeah,
So
every time I've tried to take any vacation, it's gone the other way. So I'll be landlocked here for a while. I won't go anywhere, but I hope you're calling in from some remote location in the Caribbean then, based on your recent track record.
it is unlikely to be the Caribbean, but I will be sure to take more vacation time.
Perfect.
Well, let's talk about this because there's been and you've written a lot about decoupling of macro and digital assets over the past couple of months. And I think over the past week or so, we've seen a different type of decoupling, at least from equity markets to an extent. And I think it's really based on, what we've seen in the bank failures and kind of safety of money to a pretty substantial rally in digital assets and specifically in Bitcoin. And I know Bitcoin is not something that we talk about a lot on this podcast, and there's no shortage of resources and talking heads to talk about Bitcoin and tell people that they don't understand. But I think this is about as bullish of an environment for Bitcoin as I've seen over the past few years.
Yeah, for sure. And I think you got to go back. Like you said, we've been on very loudly talking about how digital assets have decoupled from the macro environment for basically 9 months now, and I think the rest of the world is finally coming around to it. But it's like this. It's been happening since June of last year. And that doesn't mean that macro isn't a part of the story when it comes to digital asset prices. The difference is first half of 2022, macro was all that mattered for most asset classes, including digital assets. Whereas for the last 9 months, macro hasn't been driving the bus anymore. It's just been a passenger on the bus. So it's had an effect, but it's not been the biggest effect, right? The biggest effect has been the idiosyncratic events in the digital asset market, from Luna's failure to FTX's failure to the Ethereum merge, et cetera. Right now, over the last 4 weeks or so, we're kind of back into. It's actually funny because the prices are decoupling from equities, but actually we're back to coupling with macro, right? The events of the last 4 weeks have been very macro driven, related to this banking crisis. And you actually have to go back about 4 to 6 weeks ago. There were rumors, in end of January, call it, about Operation Choke Point 2.0, right? The reference was. Back in the Obama administration, there was something called Operation Choke Point, which essentially was saying the government, the U.S. government, had no real jurisdiction over some industries that they didn't like, things like payday lenders, things like cannabis, but they did have obviously jurisdiction over the banks. So they basically cut off access to industries they didn't like via the banking channel. The thought 6 weeks ago was that same thing was starting to happen here in the U.S., where there was no real ability to regulate crypto appropriately, but they could start shutting off bank lines. And I wrote something, 5 weeks ago that said if that actually were true, and I didn't have any reason to believe it was or wasn't, but if it was true, it would actually be incredibly bullish for digital assets, especially Bitcoin, because essentially, if you cut off the on-ramps and off-ramps into this industry, you effectively just leave this ball of money, 200 billion of stable coins that has nowhere to go except for into other digital assets. And if you start to cut off the banking lines, then you start to be questioning whether or not your stable coins are even safe to begin with. And it actually makes it even a safer argument to own something like Bitcoin or ETH than it would be to own a Tether or a USDC or some other stablecoin. You fast forward 6 weeks later, and obviously a lot of this has played out, right? Some of the banks that are in trouble were, crypto focused banks like Signature Bank and Silvergate. Others had nothing to do with crypto, like obviously Credit Suisse and First Republic and Silicon Valley Bank. But the point remained, which is everybody who uses the banking system is starting to rethink and recalibrate what a safe asset is, right? This was bigger and larger than what we expected when we wrote about it 5 weeks ago. But the same principle applies, which is that normally when you think about, I want to just keep my assets safe, I don't want to be an investor. 6 months ago, your list was cash in the bank, cash in a brokerage account, maybe direct treasury ownership through Treasury Direct or something like that. And then down the list, you have plenty of other things, Bitcoin and ETH and other bearer assets being somewhere down that list. Well, once you have a banking crisis and every small business owner and every person who has to make payroll and everybody who has money in the bank above the FDIC threshold starts to question, wait a minute, do I actually own my deposits or am I just an unsecured creditor and really I'm just the liability of the bank? You start to think about, well, wait a minute, maybe I need to reorder what it means to just have a safe asset. And all of a sudden, holding cash in a bank or holding a stable coin becomes very low on that list. And the highest thing on the list is, okay, well, I want to have assets in a brokerage account because those have SIPC protection. You actually have real rules around segregation of assets, no rehypothecation. Second on that list, I mean, maybe, the strategically important banks, your JP Morgans, your, Citigroups, your Bank of Americas, because, those are too big to fail. And we've seen, explicit government support before. Third on the list is probably Bitcoin and ETH at this point, which is a bearer asset and something you can own. And I'm not naively saying that every small business is all of a sudden going to be like, all right, that's it. I'm putting all my treasury into Bitcoin and ETH and I'm going to make payroll in crypto. Like, obviously that's not happening. But every small business is run by actual people, and actual people also have money. And those people might be saying, you know what, I do want to own some Bitcoin and ETH. I do want to have, a bearer asset and not be, just some sort of liability on a bank's balance sheet hoping I get my money back. So I think this is one of probably the biggest regime changes or biggest secular shifts that we've seen, certainly in the last 3 years. I mean, the last one, in my opinion, that actually mattered for Bitcoin was when Facebook in 2019 announced that they were getting involved in stablecoins. That was April 2019, which led to a huge Bitcoin rally. And maybe also in 2020 when you saw like Paul Tudor Jones and Tesla and some other MicroStrategy and some other companies starting to dabble in Bitcoin. But certainly in the last 2.5 years, this is the biggest bullish Bitcoin narrative we've seen.
Yeah, I mean, those other things, Tesla, Paul Tudor Jones, Meta, those are very micro catalysts, not necessarily kind of top-down macro. I think, obviously we have seen the rally, and the directional call was correct. I wonder about the reason behind it or the rationale that lines up. I mean, I guess first of all, if you're talking about on ramps and off ramps, and they haven't been shut down, like you can still move capital. I mean, Coinbase is open. There's ways you can move capital and take dollars out. But I don't know that from a short-term standpoint, I think that makes sense. Medium to long term, if you can't move money in or out, you're not going to see real growth in the market. So the idea of entities or individuals moving their money out of banks and into Bitcoin doesn't really make a lot of sense if you cut off the on ramps and off ramps, or even if you think that the on ramps and off ramps are going to be cut off, because why would you want to move your dollars to Bitcoin if you're truly concerned that you won't be able to get them back?
Well, I think there's a couple of, I want to focus on that for a second.
Yeah,
it's almost impossible to shut off an on ramp, right? It's really off ramps that you can shut out. There's always ways to get money into a system. It's getting it back out into the banking system. That's
fair.
So I think there's a couple things, right? First, you have to think about the money that's already in the system, right? This is already a $1 trillion plus asset class, of which, as I mentioned, at least 20% of it was in cash-like substitutes, like stable coins, or even just cash in bank accounts, like your signatures, your Silvergates, et cetera. That money, a lot of that did start to immediately flow into Bitcoin and ETH, and we saw that on chain, right? We saw stablecoin balances going down on exchanges. You saw stablecoin redemptions. You saw flows going into Bitcoin. That part is very easy to track. That was happening. The other one is a little harder, right? Is there new money coming in, and is that going into Bitcoin? If knowing that they're in the back of your head, you might be like, I might not be able to get it out. And I think that's where the secular shift is happening, is that for a while, most people think of Bitcoin and ETH in terms of dollar terms, right? What is it worth in dollars? Can I get my dollars back out when I want to spend them? What I'm suggesting is around the world, not just here in the US, around the world, the question of can I get it back into dollars may not even be the question so much as it is, do I still own this in 5 years? And I think that's where it changes, right? You're not necessarily thinking, what is my Bitcoin worth in dollar terms? It is, if this gets materially worse, I want to own a Bitcoin just in case. And I think that safety net, which has always been a part, obviously Bitcoin has 1,000 narratives and shifts all the time, some of them real, some of them not. One of the narratives that people have ascribed to Bitcoin for a decade is that it would be this sort of safety asset, this bearer asset, this, sort of store of value. And I think we think of the word value, a lot of people think of that in terms of monetary dollars. I think right now the value is nobody can take it away from me. And I think that matters. And I think you are seeing some of that, right? In fact, you can see it in the fact that there's actually been outflows of Bitcoin-related ETPs and ETFs while Bitcoin's price is going higher. And that's because, well, again, if you own a Bitcoin, if you own a representative of a Bitcoin through a ETF or an ETP, again, it's still not a Bitcoin. That's different than owning it and putting it in a self-custodied wallet. And you can see that, right? You're seeing sales of things like Trezor and other self-custody wallets go up. You're seeing downloaded apps, crypto-like apps where you can physically own and custody your own assets, like Coinbase. Downloads of apps, crypto apps are going up while downloads of financial apps are going down, banking apps. So you are seeing a lot of empirical evidence that this is actually happening. And again, I think it's less about can I get my money out right now, and more about, is there something that I own that is safe and is not subject to government manipulation or seizure? And again, always been a part of the Bitcoin narrative. Most parts of the world, it's fairly irrelevant because you trust your governments at least a little bit. Some parts of the world, you've never trusted your government, and it's always been. But that's the thing that's changing right now, is that there's no part of the world right now that doesn't have something in their back of their mind that says banking isn't what I thought it was.
Yeah, I mean, it's analogous to putting your money under your mattress, right? But whether it's a lack of trust in the overall system, which could mean actual seizure of assets, or the narrative that seems to be, behind kind of a lot of this Bitcoin rally is the devaluation of the dollar and, insolvency of banks and government, which I think is flawed thinking, at the very least, kind of uninformed. But if the argument is that the dollar will no longer be the global reserve currency and that it will be Bitcoin because Bitcoin is fixed or whatever the rationale is, then that seems to be the kind of driving force behind the rally, as opposed to I need to put my capital into assets that I control.
I mean, maybe, right? I mean, again, you're pointing to everything related to the dollar, right? I think most rational people, obviously, you have your incredibly loud Twitter personalities and hyperbolic reactions of this is going to be hyperinflation, the dollar is going to be worthless. I mean, I think most people don't believe that, right? The dollar is still the global reserve currency. Nothing's going to change that. But it doesn't mean that you have to have 100% exposure to the dollar or 100% exposure to banking systems within the United States, right? I think the analogy would be more like, just because a small percentage of the population has a bunker, to go into just in case there's a, catastrophe, doesn't mean they're also selling their house to live in the bunker. It just means they have it as a safety net just in case. And I think there is a part of everybody's assets right now that are either directly flowing into Bitcoin or ETH, or at least that discussion is on the table, right? I mean, I spent most of the last week, I had some family in town. I was doing some baseball with my children. I spent most of the last 10 days with people that are not in finance, that were not small business owners, people that were not directly necessarily affected by payrolls potentially being shut off, or the fact that the FDIC and the Fed and the Treasury had to come in and backstop and put swap lines in place to make sure banking functioned. They weren't directly affected. They still knew what was going on. They saw the headlines on CNBC or on the Wall Street Journal or Barron's or the New York Times or whatever. They are having conversations about, maybe I'm not moving all of my assets out of the bank, but I'm certainly a little nervous, right? I mean, we saw massive outflows out of regional banks into things like JP Morgan and Bank of America, into money market funds. I mean, these are real flows, right? And it doesn't necessarily mean, again, that every single person is all of a sudden like saying, that's it, the dollar is dead and I'm going to put all my money in Bitcoin. Of course, that's not happening. But even the slightest doubt in the way we used to think about money and assets trickles into an industry like this, and it has a very big effect on price. And I think, part of the reason we never talk about Bitcoin or we don't even make big investments in Bitcoin is simply because we can't value it, right? To me, Bitcoin at $5,000 or Bitcoin at $500,000 really is sort of irrelevant, right? What's relevant is that Bitcoin is worth something. It has some, long tail probability of being worth a lot. And it's nice to know that I own it and nobody can take it from me. And again, that's property has always existed, but it certainly carries more weight today than it did 15 days ago. So I think, again, these are marginal, these are marginally more inflows related to something that is not margin at all, which is a very big deal in terms of the way we think about assets and safety.
Well, I guess it's relevant only in the sense I'm talking about, dollars compared to Bitcoin, because, Bitcoin is a currency and all currencies can only be valued relative to another currency, right? And if the dollar is the global reserve currency, meaning, everything is essentially denominated in dollars from oil to Bitcoin, then it only doesn't matter if and when Bitcoin becomes that global reserve currency, where you don't see dollars quoted unless you're looking at it from the perspective of a euro or a Swiss franc, but you see Bitcoin denominated in dollars. If we get to the point where it's truly one sat equals one sat, and you look at dollars priced in Bitcoin, or you look at what's the price of Microsoft right now, and you look at it denominated in Bitcoin on a per share basis, then it truly doesn't matter. But right now it does.
Yeah. And as I don't think you need to have a completely hyperbolic reaction of all of a sudden everything's going to be quoted in Bitcoin terms. I don't think we're obviously nowhere close to that, right? A 30% jump in the price of Bitcoin is nice. It shows that there's demand and there's inflows, but it doesn't mean that all of a sudden you're going to go trade Microsoft versus Bitcoin, or go shopping and buy your clothes, in Bitcoin terms, right? We're a long way away from that. But I will tell you that, here's an actual conversation with my wife. She said, should we have more cash just in case this banking thing gets worse? And I said, well, if the banking things get worse, why do you think your cash is going to be worth something? And she was like, well, I don't know. What if there's just a mass shortage on gas? We can't get anywhere and we need to go to a gas station and get gas, and they don't take credit cards because the banking system is down. I said, yeah, it's a good question. In that scenario, would actual cash in my wallet be more or less valuable than, say, Bitcoin or ETH? And I think most likely it would still be cash. But there is an argument that if banking really did get shut down and credit cards didn't work, would paper cash just backed by the government still be something that people cared about using? Or would you maybe go back into the Stone Age a little bit with bartering or some other assets that are more valuable than just cash that doesn't really work in a banking system? And again, I don't think we're heading in that direction. I think this is very tail-like probabilities, but most of finance is priced like options with Black-Scholes. And once you increase the probability of something slightly, it can have meaningful effect on price. And I think that's where we're sitting right now, is that it's not necessarily an increase in the probability of success of Bitcoin so much as we have just massively decreased the probability of safety of banking.
Yeah, I'm not even going to go down that rabbit hole with the gas station example, because if credit cards weren't accepted, that would be a disaster. I don't think we're.
Yeah, but my wife is a doctor, right? I take care of all the finances for us. She doesn't care about this stuff at all. The fact that conversation even happened suggests that in the OR they're talking about it. The surgeons, the anesthesiologists, the nurses, the patients, right? This is this is the first, I can guarantee you that they weren't talking about Paul Tudor Jones buying Bitcoin 2.5 years ago, right? The inside finance world was, but this is the kind of headline news that is, again, it could just pass in 6 months. All the things that the Fed and the FDIC and the Treasury and central banks around the world are doing is probably working, right? I mean, if we've learned anything about moral hazard and government intervention and TARP-like programs, is that the faster you put it in place, the more likely you are to stave off issues, right? The fact that they basically just put $300 billion back into the ecosystem after a year of basically taking dollars out of the ecosystem to backstop the banks, and the fact that they did it this quickly after just one or two regional bank failures. I mean, that's the speed of this and the size of this dwarfs what we did in 2008, right? Ultimately, the size of TARP was much bigger, but it took a long time to get there. The fact that they're doing this quickly, may mean in 6 months nobody thinks about this ever again. But again, just the fact that people are having the conversation, just the fact that, again, you have to put that ranking system in there of like brokerage accounts, too big to fail banks, bearer assets like Bitcoin and ETH, and then your checking account and your stable coins. Just having that conversation raises the probability of Bitcoin's success, and it also decreases the probability of people just stashing cash in the bank account and acting like it's going to be there forever. And that's enough to change the narrative, to change the conversation, and to lead to significant flows. I mean, most of what we're seeing in the last 10 days is the exact opposite of what we thought 11 days ago, right? I mean, 11 days ago, we had an 80% probability that the Fed was going to increase rates tomorrow by 50 basis points. Treasuries were selling off, and tech stocks were selling off, and value stocks were going up. And then immediately after the problems at Silvergate and then Silicon Valley Bank and everything that's come since there, First Republic, Credit Suisse, et cetera, it's been the exact opposite, right? Treasuries are ripping. Tech stocks are doing well. Value stocks are going down. Banking stocks are getting crushed. Bitcoin and ETH are going up. So it's been a lot of volatility in prices related to very small changes in sentiment and ideology of what banking and the financial system is.
Yeah, it's interesting. There's a lot of, I think, paths that one can go down. I agree on in terms of the overall probability of Bitcoin, but again, I think it comes down to less about, is my dollar safe? Meaning if I have, X number of dollars in a bank account, will I be able to get my X number of dollars, right? Those dollars are safe. I mean, the FDIC is, essentially backstopping deposits, right? So you will always get those. I think the question is, what does that dollar get me? Which is again a question of inflation, and I think I don't know. I don't think we go into any inflationary, let alone hyperinflationary environment. But one thing I've always kind of considered, and it's inevitable, if you look at into perpetuity and an indefinite timeline, that again the dollar is the global reserve currency. The U.S. is the global superpower, and in periods of uncertainty, demand for U.S. Treasuries increases, which decreases the yield requirement. But should that demand start to diminish, then the yield required to entice interest is going to have to go up, and until you get to some sort of equilibrium. And people could say that'll never happen, and maybe it won't in the lifetime of the human race, but I don't know. I mean, that seems like a risk and a argument, for the ultimate survival of Bitcoin or some other asset similar.
Yeah, but I think that's true. But I think one thing you said I want to push back against, which is you said, most people aren't thinking about, can I get my money out of the bank because the FDIC backstopped it. And what you're doing there is you're saying most people went into a week ago Friday morning and came out Monday saying, oh, everything's fine. The FDIC basically backstopped it. But what you're dismissing is there's a lot of people, ourselves included, Arca, but plenty of small businesses that had nothing to do with crypto, that from Friday morning to Sunday night was on the phone all weekend wondering, am I actually going to be able to get my money out of the bank? I spoke to 4 small business owners that were just somewhat, either related or tangentially related to people at Arca that were in the tech sector, that were in retail, that were in things that had nothing to do with crypto, that happened to have had money at a Silicon Valley bank or other regional like bank. And they were asking me, because they were not finance people, right? These are people who were, entrepreneurs in some other industry who obviously have to have some knowledge of finance in order to run a business. We're asking, like, what does this mean? Am I going to get my money back? Am I going to be able to meet payroll? And that kind of fear, even though, again, the government acted very quickly to reassure people that that wasn't going to be, bank runs across the world, that just 36 or 70, 54 hours of fear or whatever, 72 hours of fear, like that's enough to change the way you think about it. Again, it's pretty clear that the governments around the world are saying we are not going to have a banking crisis. Your money in the bank is money good. It's still enough of a psychological shift that you're seeing massive outflows out of these regional banks, right? The dollars are telling you, the dollars flowing out of regional banks into JP Morgan and Citi, which is in the $20-30 billion range, into money market funds. It's telling you that enough people were scared by this, even though the government acted swiftly, to either suggest that they don't believe this is over, or they don't believe the government is actually going to backstop the entire system, or they just don't care to find out.
Yeah. And look, I think there's a lot of validity to. So obviously, much of this was caused by the Treasury Management decisions of certain banks, and in a rising interest rate environment where, if you see, I think Silicon Valley had 25% of their total deposits withdrawn in a, I don't remember the exact window, but less than a day, very short window of time. And if you liquidate essentially your cash reserves to meet those demand requirements, and then you have to start basically selling longer duration Treasury securities, even if they are 100% money good and guaranteed to maturity. If you have to sell them at a loss, then obviously you can get a pretty bad asset liability mismatch situation, which is definitely what we saw. And a lot of this has changed over time because and there's again been no shortage of conversation about this, but 10 years ago, 15 years ago, if you wanted to take money out of a bank, you actually you go into a bank branch. Even now, if you go into a bank branch, there are limits on the amount of money that you can physically take out in cash, or even a wire. It takes a certain amount of time. It takes a few days, but we're in this world now where everything has to be instantaneous, and that creates a very different risk management, balance sheet management for banks when you talk about essentially having gates and delayed timelines of withdrawals to real time unlimited withdrawals.
Yeah, I think that's a big change, right? I mean, we talk about, you use the word bank run, right? Historically, a bank run has a connotation of people standing outside of the bank, right? Lines outside of the bank looking to withdraw their cash or cashier's checks or something like that. Now a bank run is a click of a button on the internet. I mean, what was the number you said? It was like 40 billion that was taken out of Silicon Valley Bank in one day, and Signature Bank, I think you said, had like 15 billion or something. I mean, it was like, these are massive amounts of money coming out of banks with a click of a button. That's the speed with which that can happen now, and the ease without friction, combined with the 24/7 social media that allows that information to start spreading immediately. I mean, the types of bank runs you'll see now and going forward are going to be this fast. I mean, look how many banks just got murdered in a 7-day period. I mean, I don't know if you can stop that in a day and age of internet banking and social media. So again, the fact that the government had to step in as fast as it did, I think was not only impressive, but it was completely necessary, because had they delayed even a little bit, this would have gotten, many times worse. And I think the word bailout has a very negative connotation, mostly because of what happened in 2008 and even in 2020, right? When you think of the word bailout, you generally are thinking somebody got bailed out that shouldn't have been. right? When you go back to 2008, there was shareholders of banks that were obviously insolvent, from Bear Stearns to Lehman to, WAMU and others, that were bailed out, right? Executives that made terrible decisions were bailed out as a result, right? The people who shouldn't have been bailed out, the ones who knowingly took the bad risks, were bailed out. That obviously wasn't the right outcome. Even in 2020, right? Airline executives who had been buying back shares for decades all of a sudden were requesting bailouts. Like, look, if you buy equity in a quasi-nationalized industry like airlines or healthcare or finance, banking, that that is a risk. There is a risk that you are going to be wiped out, right? In my opinion, the wrong people were bailed out in 2020 as well. But this one was different, right? In this case, the equity shareholders, for the most part, were not bailed out, right? The equities were wiped. The executives are not being bailed out, but the depositors are. And I think that was the right move, because if you're depositing in a bank, you aren't supposed to be thinking about the health of this bank versus another bank. I mean, yes, FDIC protection is very well stated. Everybody should have known that if you put more money into a bank above the FDIC limits of protection, that you are taking risk. But I don't think you want to get into an environment where everybody who deposits money into the bank all of a sudden has to become a top tier hedge fund banking analyst to figure out, and reading 10Ks and annual reports to figure out the health of the bank before depositing the money. So I think in this case, the fact that, the depositors were bailed out was probably right. And I think, that will be important when you think about risk going forward as well, right? There's a reason that banking stocks continued to get killed even after the bailout last Monday, because it was clear that the shareholders were not the ones that were being bailed out. So I just think, again, like, we're going to look back on this 6 months from now, 12 months from now, 18 months ago, and it's in just a very short period of time, even though, quote unquote, the banking system was saved, a lot of perceptions and ideologies around what it means to invest and be a depositor and hold assets have changed, right? Everything from the riskiness of what assets you hold to the places you store them, to what it really means to be an equity holder or a debt holder, or, in this case, a token holder.
Yeah, well, I mean, look, there's clearly a lot of people, and you can tell just by looking at Twitter, who don't understand the business of what banks actually do. And then two, the 250K in FDIC insurance is one, totally arbitrary, and two, also pretty irrelevant if you're talking about a quote unquote bailout or, hyperinflation or the government being on the hook, right? Because, if you have $2.5 million, I could put $2.5 million in a bank account, or I can put 250,000 in 10 different bank accounts, right? In the second scenario, the FDIC is still on the hook for $2.5 million. It's just that, I have to go through the headache of having 10 different bank accounts, right? But it doesn't change the end amount of insurance, the sum of the end amount of insurance. So like why have that loophole? Just protect deposits if you're going to do it anyway. This is the second time it's been done. They did it in 2008 too.
Yeah, for sure. And I think, the size of the economy, the size of what businesses need to have in checking, I mean, all that stuff you said, it's grown at a size that is bigger than what the FDIC protects, but ultimately the amount of money the FDIC protects is sort of irrelevant, right? I mean, I think, if the FDIC truly backed the entire banking system, right now, as it is written, the FDIC does not have enough money to fully insure, right? You can't really be an insurance company and not have the ability to meet the claims, but that's effectively what the FDIC is doing right now. But again, that's a government issue. The government can print more money and ultimately figure out a way to get more money into the FDIC. So you're talking about things that intuitively make sense, but when you actually look at the totality of the numbers, again, there's that twinge of, do I want to wait around and see if the FDIC is explicitly backstopping everything, or just sort of implicitly saying that they'll be there if anything bad happens? And I think, new laws will probably have to get written here. I think the irony of all of this is that, unlike the 2008 banking crisis, which was really because banks had terrible assets, right? The banks had toxic assets on their balance sheets. They had, bad mortgages, residential mortgages. They were, not necessarily the banks, but the insurance companies were selling CDS of high yield businesses that were, heading towards default. the assets themselves were toxic, and the governments had to step in and basically do something to make these toxic assets worth something. Here, obviously, that's not the issue. Most of the banks were just owning treasuries, right? The quote unquote safest asset on the planet. But because yields rose so much due to the Fed raising rates, these bonds that are probably still money good and good assets were down anywhere from 10 to 20 points because of rising rates. And now all of a sudden, when you started having depositors flee, you had to start selling those assets at a big loss, generating a lot of negative equity, which obviously makes banks non-compliant with their tier one capital ratios and ultimately, in some cases insolvent. The irony is that because of the banking crisis, which was caused by rising treasury yields, we've had a flight to quality of treasuries and seen 50 to 150 basis points of tightening in treasuries, which had that happened prior would have probably solved the problem and made many of these banks not become insolvent in the first place. So certainly sort of an ironic response that the asset of choice to flock into was the one that ultimately took many of these banks down in the first place.
Yeah, well, maybe it'll be good for the ultimate salvage value. But it also brings kind of full circle just the business model, right? Like, you're rehypothecating assets as a bank, you're earning a spread. The demand deposits, you're not really getting anything for as the depositor. And if we're talking about, again, a fully kind of electronic and digital financial system, banking and otherwise, why, and I brought this up the other day, and I've been saying this for years. I mean, I haven't had a bank account in decades. And it's like, why would you? Because you can have a brokerage account. I use Fidelity, and I have check writing. I have online bill pay. I have an ATM card. I have a debit card. I can use it at any ATM, and my money goes into cash sweeps and money market funds. There's no rehab. My assets are segregated. I earn competitive yields on my cash, and I don't have to worry about a local bank, right? If I need to go to whatever ATM, I can go to whatever ATM and pay no fees, rather than I'm a Wells Fargo customer and I can't go to a Bank of America ATM because I'm going to pay a $4 ATM fee. It's just like what's the point? So I just kind of wonder, like, unless you're doing business banking with somebody and need to have an account there because of lending or some other relationship with that bank, I just don't get why any retail customer needs a bank account outside of your mortgage. That you need to have. But again, there's plenty of the banks don't hold mortgages anymore anyway. They're selling them and they're being serviced elsewhere or syndicated out, and it's just the entire model is quite archaic when you think about a digital landscape.
Well, and think about what that means. What you're just saying, right, is that most people lazily keep money in the bank and don't really think twice about it, right? If you're mentally calculating how much money you have, you're rarely segregating that into where it's held. You're just like, oh, I've got money, and that money is in a bank. Well, if you start doing the math that you just did, even if it wasn't intentional, you're effectively saying, well, now I do need to actually think about where that money is. Is it in the right places? And when you start doing that, you're like, okay, well, I'm going to hold the bare minimum that I have to hold in a bank, right? I'm just going to hold the amount that I need to make payroll, then I'm going to have no money in there until I have to make payroll again. I'm just going to hold the amount I need in there to pay my rent or my mortgage. And, when you do that across the globe, that's a serious blow to the banking system, right? When you're basically all this dead money that has been sitting in banks, think about it, right? The rates have risen, 400 basis points this year, but if you have money in a checking or a savings account, you haven't been getting paid more than 10, 20 basis points, right? They're not raising rates because they didn't need deposits, right? They've had more deposits than they need, which is why you've seen $2 trillion of reverse repo in the last year, is that banks are overcapitalized. They have more deposits than they need. So they are not competing for new deposits by raising rates and basically encouraging you to go into a money market or into a brokerage account. But most people still held their money in the banks anyway because they just don't think about it. They're like, whatever, it's just there. It's part of my just everyday, the way I do things, right? I think that's the question that is going to go forward and persist from this, is that you're just not going to lazily leave money in a bank anymore. You're going to find that alternative. And that alternative is probably, like you said, a lot of people will be brokerage accounts. Not everybody has access to a brokerage account. Either they don't meet, minimums, or they don't live in a jurisdiction where that is a viable alternative. And again, you don't need trillions of dollars to pour into crypto to make a dent, right? Just a little bit of incremental money leaving these banks, finding its way into brokerage accounts, into treasuries direct, into gold, into crypto. I mean, the smallest of those asset classes is going to have the most meaningful price increases from their fair share of assets that are being driven into the space. So I think the response, I was anybody who follows me on Twitter, I get a lot of things wrong, but I've been pretty dead right for the last 2 weeks. Just because to me this was like the most obvious setup, was that going into a week ago Friday, there's no way the government was going to let futures open on Sunday night with a banking crisis going on. Like, it was obvious that the Treasury and the Fed and the FDIC was going to come up with some sort of backstop. It was going to be terrible for regional banks, stocks. It was going to be great for the overall, risk on environment. It was going to be great for Bitcoin and ETH. That was a rational response to what was happening. In terms of where we go from here, you may not have a shotgun type response anymore like we saw over the last 10 days, but I do think you're going to continue to have a trickle down response where it's just going to be like, month over month or quarter over quarter. You're going to just continue to look at, okay, deposits are just continuing to bleed out of banks, and money market accounts are going to grow. JP Morgan, Bank of America, Citigroup accounts are going to grow, and, Bitcoin and ETH wallets are going to grow. I mean, that's just a very rational long-term response. And I think we've been conditioned as investors in the digital asset ecosystem to love the short-term boosts and the big 20, 30, 40, 50% moves. This one probably is more sustainable. It's probably going to be a very long, slow grind, almost probably similar to what we saw in April 2020, which was like, the first month there was disbelief and everybody was caught short, but then it just kept going for, 12 months. And it was just a steady inflow of, more and more indicators that, people were moving to alternatives.
Yeah. And look, I think, and this flew under the radar with everything happening. But again, Fidelity opening up, Bitcoin and ETH purchases to retail, I think including 401ks and IRAs is massive.
Mm-hmm.
As much as Elizabeth Warren hates it.
For sure. And I'll go even further with that, which is that, if you go back to, even just 3 months ago, right? I mean, crypto was a dirty word, right? Crypto was toxic. The event, certainly FTX blowing up was the biggest and most well-known and most talked about event. But there was a narrative for a couple months from November of 2022 to January of 2023 that, crypto is all going to zero. It's toxic. But when you think about it, look what's actually happened. Here are some returns. I ran this, from June 30th of last year, 2022, up until, March 15th, just a couple of days ago. Here are the returns. Bitcoin's up 25%. ETH was up 57%. BNB was up 41%. Uniswap up 24%. Matic up 146%. DYDX up 92%. Lido up 500%. Aave up 34%. I'm just taking the market leader in each category of digital assets, from currency to smart contract protocols to exchange tokens to DeFi, et cetera, right? Now compare those positive returns over the last 9 months to stocks. Well, FTX stock is down 100%. BlockFi stock is down 100%. Silvergate stock down 97%. Signature Bank stock down 100%. Obviously Credit Suisse stock down 96%. And I'm cherry picking here. Obviously, there's plenty of stocks that are up too. But the point I'm making is that, the common narrative is that crypto was burning and that, you need to protect yourself like debt and equities. And the reality is people forget that most of these protocols that have tokens that have, prices attached to them, they can't go bankrupt. They can't be primed in a restructuring. You can't put new debt or equity on top of it. You can't have the government say, oh, by the way, your asset is now worth zero. I mean, look what happened with Credit Suisse over the weekend. There was 17 billion of COCO bonds, right? These AT1 bonds. The Swiss government just basically said, nope, UBS is buying Credit Suisse. We're doing it at this price. Shareholders have no vote. and also 17 billion of bonds are going to be worth zero. That doesn't happen in the token world, right? You can't just have a unilateral response to protocols. You can't have an involuntary or a voluntary bankruptcy where your assets get primed by some new debt in the capital structure. There may be a reason why people start to also flock to other assets besides Bitcoin and ETH, right? If you want to, right now, for most of the 45 minutes here, we've been talking about safety of assets, which implies downside protection, which I think we've established that some of these tokens have. Well, now when you go the other way too and think about upside potential, a lot of these other tokens have upside potential with less downside. And I know that sounds very weird to some people to be like, oh, tokens have, more downside protection and more upside, but it's true. The upside is you're investing in early stage tech, which obviously we've seen over the years can have, 10x or even 100x return potential. But now you've also proven that they have potentially more downside protection because they're bearer assets. They can't get primed or restructured. They can't have a government bailout basically tell you you're worth zero. There's a real case to be made of why tokens actually make more sense as a way to invest in certain business models. So, ask anybody who's been investing in the banking equities, in bank equities or in bank credit lately. It's not been great. Meanwhile, go ask anybody to show your crypto returns over the last 9 months. They've been pretty good. And this has been in both good times and bad times. So I think, again, this is just a secular shift in terms of just thinking. And again, it doesn't mean it doesn't mean every small business is going to rush and put Bitcoin on the balance sheet. Like I try to be the anti-hyperbolic response, right? I'm not looking for, what can I put on Twitter that's going to make, everybody go bananas saying that I'm calling for $1 million Bitcoin or like some other, ridiculous responses you've seen recently. But I do think everybody is now having that conversation. They're having that conversation about what does it mean if I own equity? What does it mean if I own debt? What does it mean if I have money in a bank? And when you start asking those questions, it doesn't take a ton of money flowing out of one asset class or one bank into something else to make a big difference in price. And that's what we've seen over the last 2 weeks, and it's what I think we'll see over the next 2+ years.
Mm-hmm. Yeah, I mean, there's a lot to chew on there. I think that makes a lot of sense. I do think that makes a lot of sense. Well, I guess one random question that I thought of the other day because I was watching this interview with one of those Bitcoin related businesses on CNBC and just kind of shouting match. But the guy on CNBC was asking some pretty pointless questions. But since it's distributed, right, and it's theoretically, I guess, possible that a singular entity could invest enough computing power to control over 50% of the network. Like, is it at all feasible? Like, say the U.S. government decided to massively invest for whatever reason in Bitcoin mining power and hash rate. I guess I don't even know what kind of investment it would take to control 51% of the hash rate. But then it would become pretty centralized. And what, like, is that feasible? And what in essence would happen? Like, they could in essence change the rules or shut the network down, or I guess you could just fork it or something. But
yeah, I think these are the kind of discussions that are worthy of having. And usually, when somebody poses something like you just did to me, the first thing I think about is like, what is the actual numbers or the workflow that get you there? And I have not computed that, right? So I don't know the answer. A lot of times you can throw out a hypothesis and say this is feasible, but then when you actually crunch the numbers, you're like, well, it's feasible, but by the time that would happen, Bitcoin would be at 250,000, and I'd be happily selling all my Bitcoin there anyway. So sure. I don't know what the numbers look like, but yeah, there is certainly a risk that certain networks could potentially be 51% attacked, or they could end up, in the case of proof of work like Bitcoin and mining, that you could end up having a significant amount of the hash power and ultimately mine it. But even that, 97% or more, I believe, of Bitcoin has already been mined. So, being in control of the 3% that hasn't been mined yet isn't going to get you to significant centralization. You'd also have to go out there and buy a significant amount of assets that are already in circulation to get any sort of a meaningful centralization there. To your point, also, a lot of these networks could simply just be forked and start over with similar property. So I think I think these are good discussions to have. I'm not prepared to give you answers, but I think those are the kind of things that are certainly worthy of looking into. And again, if you're even having that conversation, by the time you get to a level of, the U.S. government bought too much Bitcoin and is now controlling mining, you're probably going to do pretty well as an investor over the time period that happens. So the fact that we're even having asking those kind of questions, to me, is fairly bullish, for Bitcoin as well as for other assets in this ecosystem.
Yeah, I'm just trying to think of what is the counter to, the only decentralized asset, and and it is. I mean, it is a truly decentralized asset. It's quite impressive, frankly. But I find it hard to believe that it's infallible in whatever sense. There's got to be something.
Yeah. I tend to agree. I mean, there's very few things that are infallible. I mean, if there's a loophole or something to be exploited, somebody will eventually find a way to exploit that. We'll see. I mean, this is to me the beauty of investing in digital assets, though, is that it is a very venture-like approach to early stage technology, but you get to do it in a liquid fashion, which means you can change your mind when new information comes to light. So I think that is something that we've never really seen before, right? The ability to get venture-like returns in a liquid asset class where you can change your mind when new information presents itself.
Yeah, I mean, look, we're talking sub 15 years of history. Like that's nothing. Like in the grand scheme of things. I mean, how long were dinosaurs around? Right? They were thinking, we got this. We're not going anywhere. We've been around for 30 million years. We're not going anywhere. I don't see any walking around right now.
But I do love when we get to the point of the podcast where we're talking about how dinosaurs felt 60 million years ago. So I think
they were like, we got this. Nothing's happening. We got this.
Yeah. They were very
around forever.
Yeah, that's true. I remember, a lot of the blogs written by dinosaurs 60 million years ago were very overconfident, for sure.
Do a lot of research on that. Do your work, do your homework. Well, Jeff, it's pleasure as always. Good luck in baseball this weekend. I'm sure you guys got some big games. The 8U 4-0 Supersonic have a big Saturday showdown against the Hypernova. 8U is all like NASA and space team names, which is kind of cool.
That is very cool. Yeah, well, good luck to you as well. Yeah. Over here in LA, the top level 10U team was 4-1 down in a tournament this weekend in Arizona. So pretty good showing there. The Del Rey American Little League is kicking off. My team, the Nationals, is tough start, 0-3, but I think we're going to bounce back this weekend and beyond. So I'll keep you guys posted on future podcasts.
National. Did the skill level of the Little League teams mirror the quality of the MLB teams? Like the Nationals have to be bad, and the Astros are good, but they kind of get accused of cheating all the time.
Yeah, all the cheaters get put on the Astros, and it certainly goes that way. Also, shout out to the World Baseball Classic for anyone who watched last night. What a thriller between Japan and Mexico. That was awesome, and I hope people. I assume by the time this airs, the USA Japan game will already be over. But this World Baseball Classic has been awesome.
It has. It's been definitely the best one, and the one I've seen the most kind of interest in. It's cool. The sports where the international competition is really strong, tends to parallel with less popular sports in America. But this one's cool. This one's really cool.
Yeah, well, I mean, look, come to future Between Two Chains episodes where we'll talk about the future of technology and banking, and also go back 80 years back to when anybody cared about baseball. So we can hit a lot of different.
We went back, 65 million years earlier.
And we got a lot of range here. So.
We do. Yeah, this over time we'll evolve this podcast into The View. Where we just talk. I've never actually seen The View, but I can only imagine what they talk about. We can just talk about whatever we want.
Looking forward to it, sir.